Thank you for joining us today. This is the second and final session of our post-conference workshop on FRTB. Yesterday, we covered several important topics, all centered around standardized approach for the market risk in a trading book. Today, we're going to focus on all of the approaches, and actually there are, surprise, more than two, for the risk in CVA. So we will have, in the format of this workshop, we cannot begin, from the first principles, talk about counterparty credit risk, then introduce CVA, then introduce risk. So I will, just given that we only have two 30-minute sessions for the core presentation, I will skip, perhaps to go very fast on some of the topics, but I will try to do the same as we did yesterday. Once again, inspired by Michael Pichtin's paper, from many years ago. I will introduce CVA. I will explain why CVA capital charge is different. It is not the same as the charge for counterparty credit risk, and what each one of them does. And then I will try to analyze the regulatory methods provided in the latest MAR50 document. In terms of how they relate to first principles calculations of risk and how they relate to various approximations for CVA and for the volatility of CVA that we can come up with on our own. And we will see that, the regulatory treatment makes perfect sense. We will see exactly what approximations are being made, what assumptions are being made. And then after the main session, we'll have 5 minutes. I'll just quickly show how to navigate through the spreadsheets that one of the participants asked about yesterday. And we will provide the spreadsheets for download along with the slides for today's session. And then after that, we go to the panel. And as before in a panel, everything goes. You can ask any questions. We can continue with some of the questions that we covered yesterday. We can also talk about the internal models approach for the standardized, for the trading book. As you know, it was canceled for CVA, but it, is alive and well for the trading book. Or any other topic that is of interest to everyone. All right, so let me get started. And with that, I will share my screen. One moment. All right, so here's the first slide. First of all, what are the objectives today? We will review CVA capital methodologies in MAR50 documents. Okay, and actually there are 4 methodologies there. So one, not much of a methodology, but it is a choice that you can make, provided that that your portfolio notional is not very high. It's called alternative treatment. And under this alternative treatment, CVA capital is just said to be equal to counterparty credit risk capital. So we'll have a slide on that. Then there are not one, but 2 basic CVA approaches. So one is in BVCV stands for basic approach for CVA. Is one of them is no supervisor approval, no hedge recognition. So this is something for perhaps this is something perhaps for a bank that doesn't do much of trading that attracts CVA, doesn't hedge CVA. It's just something better than this alternative treatment. Then we can progress from there to the next approach, which is full BVCV. So that's a more sophisticated approach. It recognizes the key kinds of hedges that you can use to reduce your CVA risk. And this is specifically hedges for the counterparty credit risk. Even though only several specific instrument types are eligible to be these hedges, these really cover most of the risk that you experience in CVA, but not all of it. Because CVA is not only sensitive as a measure of credit risk or present value of credit, future credit risk, is primarily sensitive to the credit spreads, but not only. It's also sensitive to things like the yield curve, everything else that the price of the trade is sensitive to. You also see the sensitivity in CVA. So even in the full basic approach, you will not be able to recognize hedges for that part of CVA sensitivity. So, and if you'd like to do that, there is a standardized approach, which requires supervisor approval. And after, regrettably, internal models approach for CVA was canceled, it became the most risk-sensitive approach available in the regulation. Today, we will focus on the unique nature of CVA and its capital requirement, and we'll rely on prior discussion of the standardized of the sensitivities-based method for context. And as before, in the format of this workshop, which is only 2 hours, we cannot go through every calculation step. So I will summarize the unique features that distinguish CVA, but other than that, we will rely on the material that we covered yesterday, because standardized for CVA and standardized for the trading book are actually quite similar. All right, now we will continue the session with a very brief overview. So it's not going to be a full-on demonstration, just to show some spreadsheets that we're making available along with the materials. So one thing is, again, I'll say it now and I'll repeat it later. Please don't run it in production. Please don't use it to give your boss some opinions about what the capital charge is. This is a learning tool, right? So the spreadsheets, if we included every single line in the regulation in the spreadsheet, it will become so complex that it will be practically useless. So there are some things that are not reflected there, which are outside of this example. So this is a learning tool. This is not something you run in production, or even to get some guidance on how large your CVA is. It's just a very simple learning tool, right? And finally, we'll have a panel discussion. All right, so now we'll start from the fundamentals of CVA, and here, what are the, what is CVA? And I will assume that everyone who logged in today is familiar with CVAs, but just to recap, it's an adjustment to the valuation of bilateral derivatives and security financing transactions due to the risk of counterparty default. So CVA is not risk, it's a contribution to P&L, but its changes represent risk. Like P&L, CVA is calculated in risk-neutral measure, and when counterparty credit quality deteriorates, CVA contribution to P&L shows a loss, right? So the more risky the counterparty, the greater the present value of future, which is negative because it's a loss, the greater the present value of the future counterparty credit loss or potential loss. And that's why CVA becomes a greater negative number when counterparty the credit quality deteriorates. The spreads widen, you experience loss on CVA. So during the financial crisis, and that's the reason why CVA capital charge was introduced, is that during the financial crisis, very few counterparties defaulted, but most counterparties experienced deterioration of credit quality. So this resulted in greater CVA losses due to the credit quality deterioration than counterparty credit risk losses due to the actual defaults. Right? So in other words, very few companies, Lehman, of course, famously, but also a few others, few companies defaulted, but a lot more companies temporarily became more risky, and that resulted in a loss on CVA in the P&L, not unlike market risk losses that occur when the markets move or during the same financial crisis. So that's why we need the CVA capital charge, because it provides capital buffer for CVA losses. Okay, so a simple example. On a portfolio of derivatives, the sum of two parties P&L is 0, right? So it's a zero-sum game. I enter into a swap with you, your loss is my gain, and vice versa. Okay, well, the caveat, right? So unless we begin thinking about very high matters, right? Shareholders, bondholders, risk transfer between shareholders and bondholders, value transfer, funding value adjustment. Everybody, I'm sure, have heard this over the past 5 years at every conference, about 10 presentations, and other philosophical matters, right? So we will not concern this with that today. So yes, two banks surprisingly enter into a swap. Actually, it turns out that it's not a zero-sum game. It turns out that actually when two banks enter into a swap, there is also wealth transfer between shareholders and bondholders. So topic for probably not one workshop, but multiple, and we'll not talk about it. So primarily, these are small corrections, or relatively small. They're not in CVA. So from the CVA perspective, from the credit risk perspective, one party's gain is the other party's loss, and the sum is 0. When the counterparty defaults, when the P&L is positive and our P&L is negative, right? So when they're up and we're down, right? So we owe them money. The creditors will take over the portfolio, or it will be unwound at cost, depending on what kind of bankruptcy they enter, resulting in no change to our financial position. Counterparty if the counterparty defaults when their P&L is negative and our P&L is positive, so they owe us money, then we just become one of the creditors to the counterparty. So from the point of view of the bankruptcy estate, we're lining up right there together with people who lend the money, right? So who bought the bonds and so forth. So seniority, of derivatives is similar, with other debt holder with the other creditors. And as a result, our obligations under derivative contracts become subject to court recovery from the bankruptcy estate. The market or the market practice is that some of the money will be recovered. It's rare that the loss is complete. So the fraction of counterparty's obligation to us that we expect to recover is called the recovery ratio. And 1 minus the recovery ratio is loss given default. So essentially, if at default the counterparty owed us $1, then a recovery ratio, let's say, is 40%, then 60 cents we get back. So CVA is the present value of this potential future credit loss, but taking into account that some of the money will be recovered. Now, consider a counterparty whose default is certain and imminent. Right? So in other words, we know for sure that it's defaulting tomorrow. Sort of like, in a financial crisis on Sunday, everybody knew that the next morning Lehman will file for bankruptcy, right? That type of situation. For such counterparty, CVA is equal to counterparty credit risk loss that's about to happen, right? So CVA on a transaction that's about, with the counterparty that's about to default, is equal to the loss that will happen tomorrow, right? So it's expected value of a future loss. If you know for sure that the loss will occur tomorrow, then it's just the same value. And you can also express it as PV of the portfolio where risky, PV where counterparty credit risk is taken into account, minus risk-free PV where counterparty when it's not. And also remembering that LGD is 1 minus the recovery ratio, you can express this as risk-free minus because it's a loss, right? So we'll use convention that CV is negative in this formula. So it's risk-free PV times the loss given default. Okay, and in most cases, right? So that's an extreme case where both counterparty credit risk tomorrow and CVA value today, they're just the same. So in most cases, that's completely different, right? So in most cases, counterparty has low risk of default. If this is the type of counterparty that you as a bank would like to trade with, it likely is highly rated and has low risk of defaulting before the derivatives within the portfolio expire. And if they default after maturity of all of the derivatives you have with them, which arguably could be very long, maturities would be 30-year swap, but still the majority of exposures are usually shorter dated. And if the counterparty defaults after the expiry of all of the derivatives in the portfolio, then you don't experience any loss. So you carry very much for them, but it doesn't hit your pocket. Right, so CVA is the risk of continuous change. So in this case, CVA, that's what makes CVA much smaller than potential credit loss in most cases. So CVA is a risk of continuous changes to the counterparty credit spread. So CVA risk. So when counterparty credit spread and other market risk factors change, CVA changes, and this risk of changes in P&L is what the capital protects against. And counterparty credit risk is the risk of a sudden event, counterparty default. So the relationship between CVA risk and counterparty credit risk is the same as the relationship between the credit spread component in the sensitivities-based method and the default risk charge in a standardized approach, right? So in other words, if we're talking about the issuer, we have one term in the sensitivities-based method where we allocate capital for the changes in the credit spread of the issuer. In a separate default risk charge for the event, capital to protect in case of an event of issuer default. So CVA risk is like CSR, counterparty credit risk is like DRC if we substitute issuer for counterparty. So these are in perfect symmetry. Now, why do we need both CVA capital and CCR capital? This is actually something that's just not, a hypothetical question. I remember when CVA capital charge was initially introduced, many years ago in 2015. I actually seen a number of presentations where speakers at conferences examined whether, in fact, there is some double counting. And actually, just to spare you the whole deep discussion, yes, there is some, but not a lot. And in fact, you can eliminate it if you subtract the already existing CVA loss from the counterparty credit risk that you allocate the capital for, but it's not a huge overlap. And you can think of it this way, right? Suppose that there is a counterparty that never defaults, but whose credit spread goes up and down. So we will experience CVA losses, but never a counterparty credit risk loss, right? So this is shown, in the bottom, there's a chart where you have assets minus liabilities. So when liabilities exceed assets, then there's default. So top line shows what, if assets and liabilities follow this path. So in this case, assets minus liability goes up and down. counterparty credit risk goes up and down, default never occurs. So you do experience some volatility of CVA P&L, and you need capital to protect against that, but there is never a default. So you never really, you never lead, in this case, you never experience the loss that counterparty credit risk capital protects against, but you do experience a loss that CVA capital protects against. Now, the opposite, right? So counterparty, which is perfectly stable, credit spread is constant, and then suddenly it defaults. In this case, we'll experience an eventual counterparty credit risk loss, but never CVA loss. So more generally, CVA capital covers future scenarios in which counterparty's assets always exceed its liabilities, right? So the top area here of what can happen in the future is covered by CVA capital. And counterparty credit risk capital covers future scenarios where counterparty's liabilities eventually exceed its assets. And in this case, they default. So this area below the x-axis or the time axis is covered by counterparty credit risk capital. So from this chart, you can see that they're not duplicate of each other. But as I mentioned, there is you have to be careful a little bit with the overlap. We need to subtract, to avoid the overlap, you need to make sure that if you already experience some deterioration of CVA, that some of it is actually reducing the loss that you have on counterparty credit risk capital. But exactly how this offset works in regulation is outside the scope of this presentation. We're here to take MAR50 apart, but this is something perhaps to keep in mind in general. All right, now history. Consultative document on CVA capital charge was published in October 2015. And this was still under the old nomenclature of BCBS documents. So it was D325 document, review of the credit valuation adjustment risk framework. It included BVCV, basic approach. It included initial simple version of standardized, and it included draft internal models approach for CVA. And in that document, SACVA was less risk sensitive, right? So it included sensitivity only to the counterparty credit spread. Now, fast forward to today, there is a current rule published in January 2019 and due to take into effect when it's implemented. It's in the MAR50 document under the new nomenclature, Credit Valuation Adjustment Framework. And here are the changes. It includes an alternative for small portions, it includes an alternative for small portfolios to set CVA charge to the same level as counterparty credit risk charge. It includes final BVCV and SACVA. It does not include internal models approach. It was canceled for CVA, but standardized acquired significantly higher risk sensitivity. And now you can, it's sensitive to a lot more hedges, and it's also sensitive to more risk. And as a result of being sensitive to detailed risk, it also became less conservative, and the capital has gone down compared to more crude approaches. So SACVA improved and takes the place of the top line approach that basically is the most risk sensitive method. All right, implementation schedule is not finalized again, so I will not venture into a guess here, but clearly still some time away. And final comment here is that for the market risk that we'll talk about yesterday, standardized approach does not require supervisor approval. Internal model approach does. For CVA, it's the basic approach that does not require supervisor approval, and standardized does. The reason is it's actually not so easy to compute CVA, so the supervisor will make sure that your bank is computing CVA correctly, and correctly means in line with the regulatory requirements, which sometimes are different and sometimes are just more stringent than the requirements of accounting requirements for something that goes into the P&L. Okay, now stated goals, right? So what are the goals of the new capital charge for CVA? Okay, so well, some goals, right? So first of all, there's recognition of market risk of CVA related to risk factors other than counterparty credit spread, right? So that's the improvement that occurred, between the initial proposed regulation or consultative document and the final framework. Now it's completely clear, even though it was not really clear in the beginning, that you must use market implied or risk neutral models for CVA. So, there were some earlier proposals in which essentially historically calibrated real-world models were proposed for CVA, which would have caused significant errors in its calculation. There is a requirement to use margin period of risk. in modeling CVA of collateralized counterparty. So that's actually an interesting one, because there are a lot of firms still to this day, and even though now the auditors as well as the regulators are really becoming increasingly unhappy with it, but I would say maybe not today, but until recently, a lot of banks were computing CVA on collateralized counterparty by simply not computing it, assuming it's zero. It's because it's smaller when there is collateral, and I'll talk about how that works a little later. So, well, there is no such option here. So even if you have collateral, and even if you have a perfect credit support annex, when your P&L with the counterparty, the amount of potential loss is perfectly offset by collateral, still there is a way that you could lose money, and we'll talk about this way. It's called the margin period of risk. And finally, there is a partial recognition of CVA hedges, provided certain conditions are met. And these are the goals, stated goals of the standardized framework. Right, now let's go through the frameworks that are available in the MAR50 document. And we'll start from what's called the alternative treatment. Then we'll progress to reduced BVCV, full BVCV, and finally it will culminate in standardized for CVA. And then we'll go to the panel, sorry, the spreadsheets in the panel. All right, so what's alternative treatment? It's literally just a few lines in the document, and it has to do with materiality threshold. So what's a materiality threshold? Materiality threshold is the threshold of notional for non-centrally cleared derivatives, because on centrally cleared derivatives, you assume central counterparty doesn't default, so that's less of a concern for the regulators. Any bank whose aggregate notional amount of non-centrally cleared derivatives is less than 100 billion euro is below the materiality threshold. Now, 100 billion euro seems like a lot of money, but remember, this is we're talking about absolute sum of the absolute values of notionals of every swap, or every derivative transaction. So actually, given that banks have a lot of offsetting positions, it's actually not in other words, it's not the type of a threshold that nobody would ever meet. So in fact, most of the banks would routinely be above the threshold. So however, if your portfolio of derivatives is small, then you're below this threshold. And the bank such bank may, but is not required to, choose to set a CVA capital requirement to 100% of its counterparty credit risk capital, which I interpret to mean that essentially it just becomes twice, right? So in other words, it's not a replacement. It doubles the counterparty credit risk capital. So here we go, right? I was just arguing that these are different things, calculated in different way, and now we're just assuming that one is equal to the other. Well, the reason is that this alternative treatment, the purpose of it is just avoid calculating anything and not burden the bank that doesn't have a large CVA risk with any calculation. And really, the closest thing that's available is counterparty credit risk capital, and that's why we assume that they're the same. Yeah. So, but of course, these things are still different. CVA hedges are not recognized. And by the way, if your portfolio is small, but still you would like to not allocate too much capital, because that would be higher capital, you can still have the right to use other approaches. It's just you're not required to. If chosen, this treatment is applied to the bank's entire portfolio, right? So you cannot cherry pick. And if the bank supervisor believes that you are below the materiality threshold, but CVA risk is significant for your bank, then this option is not available. So the supervisor has the power to remove this option. Next approach, going up to more advanced. Okay, so reduced BVCV. So reduced BVCV is the variant of BVCV which has no recognition of CVA hedges. So it's intended for financial institutions which do not hedge CVA. And reduced BVCV, so in other words, if you're not hedging CVA, then you can go for reduced. If you're hedging, you probably don't want to. So this is, again, so even if you hedge, you can use it, but it just doesn't make a lot of sense, because in terms of complexity, it's not that different from full, right? So in BVCV reduced, you have no recognition of CVA hedges, and it's intended for financial, and it assumes that 50%, it makes an assumption. When it combines risk, it combines the capital requirement from risk of each individual counterparty. It assumes that 50% of credit spread risk is driven by a single systemic factor, and the remaining 50% is uncorrelated idiosyncratic risk, right? So in other words, let's say that you have JP Morgan, well, I'm talking about American companies, but say you have JP Morgan and you have General Motors. It will assume that the credit spread, which drives CVA excuse me, which drives CVA levels and CVA risk for these two counterparties, it assumes that if both of the spreads go up, or one of them goes up and goes down, that the decomposition is that 50% of the changes are caused by the general economic environment. Let's say there is a financial crisis, there is COVID crisis. So 50% of the changes in these two credit spread of completely different counterparties are driven by the same factor. So 50% of the credit spread is something that moves them together, or is caused by something that moves them together. In the remaining 50% is unique to the industry. Let's say, there's a financial institution bankruptcy, so perhaps bank spread would widen, but a car company would not. Well, probably it would anyway, but maybe it's a bad example. Oil company, let's say, right? Or let's say if there is low oil prices and fracking in the United States is flooding the market with cheap oil. In this case, the spread of traditional oil manufacturers, oil producers will go up, right? But it will not affect the financial institutions. So 50% common cause, 50% idiosyncratic. A reasonable assumption, I would say, on average, right? And in this again, so again, I'm playing with this formula. So I just took the square, so it looks like the square form that we previously have been looking at for the trading book, right? So I'm going to on the left put K reduced, which is the capital requirement under the reduced merit squared, and then it will be part of it, right? So rho is 50%, so 0.25 times the square of the sum, right? So that's what happens if there is 100% correlation. So that's the part which assumes that there is 100% correlation. And the multiplier makes it 50% of the total change in the spread. And here it's a sum of squares. So that's what happens when they're not correlated, right? So 50% is 100% correlated. 50% of the change is not correlated at all. Again, not on reasonable assumption, certainly. And that's how the formula works. Okay, now, so that's, all good, right? But now, how do you calculate the capital requirement for a single counterparty? This formula has to do with how you combine what are the rules to combine capital requirement for individual counterparties into the total capital requirement. So now we getting to how to compute the capital requirement. Okay, so when we calculate CVA for accounting P&L purposes, right? So that's what the fair value methodology, fair value accounting. So if you put something in P&L, you have to follow certain rules. And long story short, this is the formula that you come up with, right? So let me describe, how it works. Actually, there should be a minus here, but if we're talking about capital, you can ignore it because it anyways gets squared, right? So loss given default, that's 1 minus the recovery ratio, right? So in other words, if you expect to recover everything, that's 0, and there is no need for capital. If this is a counterparty, let's say, sitting on let's say, a mountain of diamonds, and that's their only asset, and they default, but you still have the diamonds, right? So loss given default is 0, no loss. Okay, on the other hand, if this is some highly speculative, let's say, .com, which just went bankrupt and nobody wants the domain, then it's probably 100%. All right, so now this is the sum of a netting set. So netting set is a group of derivatives whose exposure added before the counterparty created loss is calculated. So it's actually is a bit of a surprise because before the financial crisis, when default likelihood of a financial counterparty, a bank, was seemed pretty remote, this was not really widely appreciated in the market. Suppose that you have a counterparty, that you have a swap on which they owe you money, and another swap on which you owe them money. You would think that these swaps would automatically be offset, right? So in other words, they cannot just default and say, hey, we want you to keep paying us, or rather the creditors will tell you, right? So the creditors or the bankruptcy will say, well, keep paying us on a swap that we're ahead on, but we're going to default on a swap that you are ahead on, right? So that doesn't seem to make any sense, but actually that's exactly how it works. And a lot of people in a financial crisis, they got bitten exactly by that thing because they traded with Lehman in London and they traded with Lehman in New York. Well, what happens is that these are different netting sets, right? So trades are typically these days netted together, but not always. You can for example, you can trade with different subsidiaries of the same firm, and this would be different netting sets. There are other reasons. So it does not happen automatically, but it happens within the netting set. So that's something to be aware of. So this is the sum of a netting sets, right? So each netting set is separate, just add it. EE and good grief, I mean, the nomenclature here is absolutely horrendous because some things are called expected exposure and some things are called expected positive exposure, but actually these are the same things. And negative expected exposure and expected negative exposure, believe it or not, actually different things and don't mean the same. Okay, so we'll try to sidestep it a little, but I think this nomenclature really is not well thought out. I would put it this way, diplomatically. So EE is effective expected exposure, and that's actually positive, right? If it's negative, it says the N in front, NE. Positive exposure means the counterparty owes us money. We're ahead, right? That's how we can have the loss. If it's zero, and if we owe them money, then it's not a concern from the capital perspective. It's their concern, right? So it's not our concern anymore. So in other words, when you make money on a derivative, you have CVA, right, and CVA risk. When you lose money on derivative, your consolation is that you don't have to worry about CVA losses because it's the other party that has to worry about it. So this is the positive part of exposure. And exposure is, again, I'll skip over the finer differences, is how much money the counterparty owes to us at time t in the future, right? So in other words, we have a swap. Maybe some of them are shorter dated, they expire. So this depends on time, because and also it depends on what the markets would do, but that's expected, right? So it's already averaged. So it only depends on time here, not on the future scenario, or if you're doing Monte Carlo model, not on Monte Carlo path. It's already averaged over that. Now, DF is a discount factor because, again, its contribution to P&L is anything, you have amount in the future. Any amount in the future is discounted at the risk-free rate. Okay, makes sense? Now, this term, SP, is the survival probability of the counterparty at time t. So the reason is that if, let's say, after 10 years, the counterparty has 50% probability of default, then this loss will be realized only with whatever probability it had times 50%. Because if they default after 1 year, then they will not cause a loss for you after 10 years. So so this thing doesn't reduce the overall loss. It just has the effect it has is kind of together with the hazard rate. It just high probability of default just compresses everything closer to origin, right? Because if from time to zero to infinity, any counterparty has 100% probability of default. So it just, if there is a higher hazard rate, which is the probability of counterparty default per unit time at time t, and survival probability is the exponent of the integral of the hazard rate. So it's just high hazard rate means everything happens sooner. Low hazard rate, it happens later. Well, it's smaller CVA because if it happens really late and all of the derivatives expire before the default happens, then you don't have a loss. So that's why there is a dependence on it. All right, so that's what we would like to have, right? Okay, well, now that's actually what we will do in the standardized. However, in basic, the purpose of basic is to avoid having to compute CVA. So the basic approach, going back to the document, is specifically its goals is stated as specifically is the methodology for counterparties or for banks rather that don't compute CVA, right? So these are for banks that don't care to perform the calculation of this particular integral. All right. So and if that's the case, what can we do? Okay. So in this case, the regulation sends us back to the counterparty credit risk regulation, but it does it in such a convoluted and I would say circuitous way that I took upon myself to simplify the formula a little. So I'll show you in a moment what I mean, right? So this is the formula. This is the regulatory formula, right? So it looks pretty different from this integral, right? So there is risk weight here. Okay, so that makes sense because we remember that risk weight is something that replaces in the market risk kind of a replacement for the volatility expected or scaled volatility expected shortfall. Okay, so it makes sense as a multiplier. Okay, so now we see something that kind of vaguely vaguely resembles what we're looking for, right? Discount factor is here, but as a constant. There is this called EEP, effective expected positive exposure. That's an effective average of this EE. Now, P made its way here because it should have been in E, but it's not for historical reasons, right? So it just, it didn't just become positive. E was also positive already. And effective means the average, right? Because it could have been expected, but expected means averaging over the paths, right? So there are two averages here. First, we average over the Monte Carlo paths of future scenarios, and then we further average over time using regulatory rules. And M is regulatory maturity. Okay, so regulatory maturity is something that is here and makes sense because we had integral over time. And now instead of integrating over time, we are multiplying by some average or expected time. Okay, so now this starts to resemble the other formula, right? So this formula has integral, there is exposure, discount factor, and this, and also there is a survival probability and loss given default. So this formula has also exposure by its averaged, discount factor by its averaged. Instead of time, we have basically the average time over which the integral is taken. Makes sense. Sum over the netting sets makes sense. And whatever was in the integral but is not in this formula is packed up in the risk weight. Okay, so now it's clear how it works. All right, now the risk weight, again, so what's packed into risk weight? Well, some measure of survival probability, loss given default is in there. And the final thing here is that if you look at the MAR50 document, you will notice that there is a parameter 1 over alpha, right? And here, instead of EPE, there is exposure at default. Okay, well, what happened is that, and this is, you know, this I would say really far out there, right? Is that, well, EAG has this multiplier, so it's alpha times the effective expected exposure. So because it has this multiplier, and there are a lot of rules on how to compute EAG, which expressed in terms of EAG, in order to refer back to the original counterparty credit risk regulation, the document drafter, and I can see how this was the only choice. So that actually is kind of not their fault, right? So I can see how it was the only choice to write the formula in terms of the exposure at default, because otherwise you essentially have to go back and say, well, you know, here you read the AG, but you mean the EPE and so forth. It would get even more complicated. So the formula is written in terms of exposure at default, and then you have to divide back by alpha. So what's alpha? Alpha is a supervisory multiplier for one wrong way risk. And the reason we don't put it here is because we're going to model it explicitly. So in CVA regulation, well, not actually in BA, but in the full standardized, we're going to model the wrong way risk explicitly. So here, some measure of wrong way risk is in these correlations and so forth. So essentially, we had to divide it back because this particular alpha really made sense in the context of counterparty credit risk, but not CVA. And the document was expressed in terms of AD, so we had to divide it back. So now, please don't pay attention to alpha for the purposes of understanding how the formula works. It's better if we just cancel it out, right? So this is why there is expected positive exposure. That will make it easier for us to make sense of it. Right, and now here's the here's the figure of that compares the two approaches. So now it actually makes more sense because on the left is the integral that we're trying to. So the dashed line shows the integral that we're trying to approximate, and the integral is the area under the curve. So there is effective exposure, which is the positive part of the exposure, and it starts from some value. Let's assume it's positive. Actually, it could start negative and then go into positive territory because we have a, let's say, loss today, but it may become profit in the future, and then there will be risk of counterparty defaulting when it happens. But let's assume today it starts from a positive value. Now, why does it go up? It goes up because derivative transactions, especially things like swaps, are usually finally balanced, right? So you enter the transaction at the money, at break-even point, where the counterparty's obligations are offsetting. And then immediately the rates go up, the receiver of the floating leg makes money, rates go down, the receiver of the paying leg or the fixed leg makes money. So because rates could go up or down, but we're only looking at the positive part, I expect that exposure will first go up and then go down for most portfolios, right? Well, here, what we're doing is essentially saying, okay, well, we're going to take the average exposure, compute it using regulatory methods. And here it's really, pretty crude, but unfortunately, that's the only thing you can do unless you're actually modeling it, which is what basic approach tries to avoid. So this square here tries to essentially estimate or use regulatory supervisory rules or regulatory rules rather to estimate how wide is this area and how tall is this area. So essentially, we're replacing it with the square, where this is our best guess of the what we're integrating, and this is our best guess for how long we're integrating it. And discount factor, it actually starts from 1 in the full CVA formula and goes down. And here it stays constant, and there is a regulatory formula for discount factor in which you assume the average discount factor based on what the maturity is, and interest rate of 5%, which I guess is a lot higher than the interest rates today in euro dollar, but certainly nothing unreasonable if you're looking at the emerging markets. So 5% is the regulatory interest rate, and anyway, it's just a discount factor, so it's not really that different from one anyway. And this M, again, so we don't have time, unfortunately, to go into this if we're to finish on time today. But there are some complexities there. In counterparty credit risk, it says, well, take M, floor it at 1 year, cap it at 5 years. And then CVA regulation says, well, never mind, don't cap it at 5 years, but you still floor it at 1 year. So it gets complicated, and you have to look at both documents literally side by side to make sense of it. But eventually, it will just a set of rules, and it's possible to follow the rules. But this explains what it does. So in other words, if you look at the formula, which is this sum of this product of constants, versus the full formula CVA, which is the integral, they appear completely different, but actually they're the same. It's just you're approximating this unknown shape of this area, and it's unknown to you unless you're calculating CVA, which basic approach tells you not to do. You just replace it by a square in which the height and the width is your best guess of the shape of that area on the left. All right, so let me just break for a second. It has been 40 minutes. You may have noticed that I didn't stop for coffee and questions. So yesterday we didn't manage to fit into the allocated time for the main session, even though eventually we just made the panel a little bit shorter. I'm trying to avoid it here. And what I would like to do is ask everyone at this point is to, if you have any questions, if you have any comments on the presentation, so please, if you'd like to say something, please put it into chat. And I'm looking at the chat on a separate device. If I don't notice that there is a chat comment there, then my colleagues will alert me. What I would propose is to break after the main presentation and before the panel, and have a little bit of a Q&A on the slides, and I think that this way we'll have more time left for the discussion. So I hope everybody is okay with it. But certainly, if anybody wants to get coffee, please feel free. I'm trying to go slow here, but it probably doesn't make sense really to stop twice here, given that we're trying to save time. All right. So with that, let me continue. Next thing here is BVCV. Okay, so full BVCV. All right, so reduced versus full, what's the difference? So the difference is partial recognition of specific CDS types for hedging spread only. So in other words, it's partial recognition of hedges, but not all hedges, only CDS, and only specific types of CDS, and only for hedging the dependence of CVA and credit spread, which is not the only thing it depends on. It also depends on all of the other market risk factors, and standardized approach takes this into account, and as well as the hedges, with respect to everything else. But in full BVCV, you're only recognizing the hedges of the credit spread and only a particular kind, and also not completely. So actually, there are multiple lines of defense here in terms of how conservative it is. So first of all, full CVA is only 75% hedged capital requirement. So full capital requirement under the full BVCV is only 50%. So there's only 75% hedged capital requirement, 25% reduced, which is what we just covered in the preceding section. So that's an additional degree of conservatives, even though K hedged is also extremely conservative. So it's conservative in how to recognize the hedges, and yet 25% of the capital is from the method that doesn't have any hedge recognition. That's how conservative it is. And that's one reason to do standardized. Right now, what are the eligible hedges in BVCV, which are actually is a more narrow list than in standardized? First of all, they're limited to 3 instrument types, all of them CDS: single name credit default swaps, single name contingent CDS, and single name and index CDS. So single name CDS is normal credit default swap. Somebody on the reference name, somebody defaults, you pay, right? So CDS on the index is also pretty conventional. Single name contingent CDS, so that's actually interesting one. So Contingent CDS is the type of CDS in which the underlying, or the amount of protection it pays, the amount of the principle of the insurance payment it makes to you if the counterparty defaults, which makes rather to protection buyer. It's not a constant, it's not a fixed sum of money. It's linked to something else. It may be, for example, linked to equity price, right? So there may be a contingency. There are different types of contingency CDS. Some of them are more liquid than others. One example is that, let's say, you're looking to hedge something that you're looking to hedge some loss, which due to counterparty default, but which depends, let's say, on how high the stock market is. So in this case, you can have a contingency CDS, which the payment is, let's say, based on the stock index. So that's one of the examples, right? There are also CDS which are denominated in a different currency, which are strictly speaking not contingent. So there are some less liquid types of CDS here allowed, but normally you would hedge with liquid instruments, which are single name CDS and index CDS. Now, it's not all, right? So not all of these instruments are available. They also must reference entity in the same sector, either one of three. Entity in the same sector and region as counterparty. Okay, hold on a second, right? So this weren't this the problem in the financial crisis, right? So that's the first question that anybody would ask reading the regulation, right? So there are very famous cases when financial institutions lost a lot of money because they had the great idea of hedging exposure to Lehman with CDS on another bank. So, well, thing is, when you're looking at, when your popular model is telling you that there is certain correlation, you can balance it perfectly and, enjoy very, very low level of desk market risk, which allows you to have, higher position, basically higher amounts of, basically book more business. Okay, well, when the crisis happens and you're looking for your CDS, not just essentially use CDS, buy and sell it as a way to invest in, a market risk factor, or take exposure market risk factor. If you're looking for CDS to actually provide protection, right? If that's the purpose of you entering into CDS, if you want to hedge it, if you want to hedge an event, as opposed to hedge the changes in credit spread or trade hedge the changes in credit spread, then of course Lehman defaulted. Other financial institutions didn't default, so that wasn't really great. Right, so entity in the same second region as counterparty is not a great idea if your purpose of buying CDS is to hedge the amount of a loss. So, well, nevertheless, it's allowed, right? So, and however, it attracts lower recognition there through this correlation factor that is at the bottom of the slide. Okay, so now the other category that's allowed is a parent, subsidiary, or peer under common parent legal relation. Okay, well, that's much better. Normally, if the parent defaults, the subsidiary defaults. The opposite is not always true. And actually, it's surprising that there is no differentiation here whether it's a parent or the subsidiary, because normally, the subsidiaries sometimes default, parents don't. The opposite is more rare. Well, they're treated the same, and actually, two subsidiaries of a common parent also the same. So it's 80% supervisory correlation. And finally, 100% supervisory correlation is when you buy or hedge with CDS on the very same name as your counterparty, because in this case, you know that if you experience counterparty credit risk loss, then your CDS will pay, and vice versa, right? So they're perfect alignment, 100% correlation. Okay, so that makes sense. Now, hedge capital requirement, and this is where I will, just summarize it, because otherwise we'll run out of time and we'll go through every detail of that. But it's also a quadratic form. It looks a little bit more complicated because now, in addition to the standalone counterparty term, which we just looked at, so this SCVA term is the standalone CVA capital requirement of the counterparty C. Plus, there is a term for the single name hedges, there is a term for the index hedges, there is a term which is additional single name hedge, which reduces this name recognition based on RHC. So that term disappears if RHC is 100%. And the expressions for these quantities, SNHC, IH, and HMAC, right? And you can see here that IH is not doesn't have the counterparty subscript because essentially it's not it's an index CDS, so it's not hedging one counterparty; it's hedging all of them collectively. All right. So these terms are similar to the term for the standalone CVA this formula with the sum of constants, right? Not the integral, but the sum of constants. Except that instead of expected positive exposure, they use hedge notional, right? So they use the amount of protection in this CDS. There are also additional terms, there are various multipliers and so forth, but fundamentally they're very similar. So the standalone CVA requirement says for a period of time X, or MCVA rather, or netting set, you have the expected value of future loss, right? Well, here you're reducing this loss by the amount that CDS will pay you, and the method to estimate it is similar. It's also a very similar product, except instead of the exposure, you're using the notional, and otherwise they're the same. So the formula here works in a way that basically these correlations, the RHC, which is in the formula for each of these terms, and the rho, which is here in this formula, they work together to essentially to dilute the effectiveness of hedges according to how much they are connected to the how much they're connected to the, or how likely it is that if you experience credit loss in the future, for which CVA is the present value, you would also be able to reduce this loss by CDS. So there is some risk that even if you have CDS on the same name, it may not pay, because basically someone who sold you CDS and the reference name may default at the same time. That's very unlikely. So normally a single name CDS on the same credit will pay if you have a counterparty credit risk loss. But if you have an index, if you have a sibling and so forth, this probability is less. So this correlation, regulatory correlation factors work together to dilute the effect of hedges in proportion to how far they are from the counterparty. Now that's the that's everything on BVCV. And once again, so just to avoid running out of time for the main session, I will keep going. If you have any questions, please type them into chat. And if there is anything, that perhaps I missed, or you have a question or correction that makes sense to address in the main presentation, I will then stop and address it. Otherwise, any questions in the chat will be in the order they are typed. We'll address them in the panel. All right. So now we're going to standardized for CVA. Standardized CVA methodology is in many respects similar to the sensitivities-based method, right? So in standardized for the trading book, you have sensitivities-based method, you have default risk charge, and you have the residual risk add-on. Well, here we're just talking about sensitivities-based method, and furthermore, we don't have curvature. Okay, the reason we don't have curvature, as we'll talk in a moment, is because CVA is computationally intensive, and the regulators, and we are thankful for that, try to reduce the number of times we have to compute CVA. So we will review only the aspects of SA CVA. We will review the differences, only the aspects of standardized for CVA that do not exist in SBM, but we'll skip routine differences and correlation, risk weights, and so, etc. So the risk classes are different. Or somewhat different. There are 6 risk classes for Delta and 5 for Vega, right? So as you remember, for the sensitivities-based method for the trading book, we had 7 risk classes, of which 3 were credit risk classes, depending non-securitizations, non-correlation securitizations, and CTP and non-CTP. Now there are 2 risk classes instead of 3, and they're sliced differently. For this standardized approach for the trading book, this were based on the type of the credit. So here it's based not on the type of the credit, but on what the credit does or who the credit is of. One of these risk classes for the CVA approach, one of the 2 credit risk classes, is the counterparty credit. And the other is the credit on the reference name that's not the counterparty. Let's say if you enter it into CDS with someone, and then that CDS has the risk not of the reference name default, but of the counterparty that sold you the CDS defaulting, and then you're losing essentially the value of the CDS. So these are 2 different things, and that's why there are 2 separate risk classes for credit. And the reason there are 6 for Delta and 5 for Vega is because there is no requirement to calculate Vega on counterparty credit spread. And the reason is that you can barely estimate the spread itself it's extremely difficult to estimate this volatility, next to impossible. So that's why really Vega there is meaningless, because you cannot get the market data to estimate it. And that's why there's no requirement to calculate Vega for the counterparty credit spread. And even when the instrument PV does not depend on volatility, so for example, for the vanilla swap, CVA on a portfolio of such instruments does, because CVA is based on expected value of potential future loss. The future loss depends on what kind of P&L we have with the counterparty, and that P&L depends on rates going up or down. And volatility makes the rates or market risk factors go up and down more or less. So if you have a portfolio of instruments whose prices don't depend on volatility, CVA on these instruments still does, and that's why you have to always compute the Vega, no matter what your portfolio is. Whereas in a standardized for the trading book, you didn't have to compute it unless there's an optionality in the instrument. Right. So now the main differences between standardized approach and for the trading book, which is called just SA, and standardized approach for CVA. So I will just very briefly summarize these differences. So first of all, standardized requires calculation of CVA to standardized for CVA requires calculation of CVA to strict regulatory standards in risk-neutral measure. So risk-neutral measure is the same measure or the same type of model that you use to compute fair value CVA for the purposes of P&L. When I say fair value, it means it goes into P&L, which is a part of fair value accounting, right? However, the regulatory standards actually, again, because regulators tell us through regulatory documents on the BIS website how to compute the risk of CVA. However, there is no equivalent regulator for the accounting standards, right? So accounting standards are determined by accounting bodies, right? So in other words, informal industry associations, and there's no formal regulator for the accounting standards. So that results in sometimes the CVA standards. So the regulatory standards for CVA calculation actually may be more stringent than the bank would have to follow putting CVA in P&L. So sometimes there are some respects, like for example the margin period risk, which is actually more stringent or more rigorous calculation of CVA has to go into capital than into the calculation of CVA itself. Okay, so now reduced granularity of market risk factors. So there is no curvature. And a lot of the standardized trading book risk factors, which had vertices or tenors for the curve. Now it's just a flat shift. And the reason is, again, so we're thankful for that, because CVA requires a lot of calculating CVA requires a lot of computing power. It's a Monte Carlo calculation on the entire portfolio. And to reduce the number of variations, it's helpful that curvature is removed, and it's helpful that you don't have to shift each vertex or tenor, and you just shift the entire curve in parallel. Now, also, there is no DRC in SACVA, even though there is DRC in standardized. And the reason is it's just in a separate regulation, right? So there's something called SACCR, which is standardized approach for the counterparty credit risk. So DRC is the counterpart to DRC is in SACCR, it's not in SACVA. More conservative risk aggregation, right? So so that's actually an interesting one, because normally you would look at it and say, hey, why not use the same risk weights? Why not use the same supervisory or regulatory calculations for the standardized approach for the trading book as for CVA? Essentially, what's the reason they're different? Well, the reason they're different, and the reason CVA correlations and risk weights are more conservative, is because you expect CVA capital losses in a crisis, right? So if you're trading, you can lose money in any market environment on your trading book, right? So in other words, you could be trading rates, and the rates go against you. Could be trading equities, the equities go against you. So that's not necessarily, well, you could lose a lot of money in a crisis, but you also could lose a lot of money outside of a crisis. In case of CVA, it's a lot more likely that if you lose money on CVA, that's because there is a crisis, because there is a directional dependence there that you experience loss on CVA if counterparty credit quality deteriorates, and that happens if there is a systemic crisis like COVID, like a decade ago, the financial crisis. So there is a greater chance of correlation being different when you have a loss compared to the normal correlation when we're looking at CVA capital compared to just the trading book capital, right? Because again, so CVA loss occurs in a crisis. Trading book capital, trading book losses also may occur in a crisis, but they're more likely to also occur outside a crisis. So it makes sense for greater conservatism here. And that's exactly what the regulation does. So these matrices that we looked at, the risk weights that we looked at yesterday, they're different here, and for good reason. There's also additional conservativeness multiplier, right, of 1.25. Okay, well, it's kind of an additional thing that lifts everything. Well, it could have been in the risk weight. It's outside, and again, so it compensates for a higher level of model risk in CVA sensitivity. So the purpose of it is not rolled into the risk weights. The purpose of it is different. And essentially, it's just saying that the regulators expect CVA models to be 25% off. Well, they may or may not be. I think if they are, actually, it's not that because the model is broken or people cannot do Monte Carlo. It's just there's a huge challenge of estimating the credit spread. We'll come to it in a moment. So I would say it's probably actually even generous, because one thing about CVA is that you can have a very precise calculation of the exposure as the auditors or regulators will require of you, and then you multiply it by the credit spread, which is really, for some illiquid counterparties is really anyone's guess of what it really is. So, but that's that's life. That's if it's illiquid, then you don't know what it is, and that's life in financial markets. So 25% I think is not unreasonable. There's also something called hedging disallowance parameter. Well, R, right? Just like the correlation of 99.9 we've talked about yesterday, this hedging disallowance parameter seems small. Well, it's not 0.1%, it's 1%. Actually, it's not so bad because, in fact, R is 0.01, but the way it enters into the formula, is really what matters is the square root, right? So in other words, is R outside next to square of something? If you put it inside, is square root of R, which is 0.1. So it's a 10% really. In other words, this hedging disallowance parameter, it looks like it's a 1%. It's actually more like a 10% if you think how it works in the formula. Okay, fine. So, there's an additional, there are now not one, not two, but three various ways in which hedges are discouraged. So, yeah, so I can see that the regulators really think that hedges will not work as intended. And I think for CVA, especially when these are credit hedges, they have a good reason to, to think that. So I think that's perhaps is not an unreasonable assumption. All right. So I see that there is I believe, a chat comment. So let me see if I can see it. Yeah. Oh, okay. I see. Right. Okay, yeah. So, Chris, thank you for correcting me. It looks like actually you're right. Yeah. So, now it was eventually rolled into the risk weight. I was just using the old slide, so I apologize for that. Yeah. All right. So now let's continue. And as I mentioned, there are different risk classes, regulatory correlations, and risk weights. Okay. So, list of risk classes: interest rate risk, foreign exchange risk, counterparty credit spread risk, reference credit spread risk, right? So credit spreads that drive the CVA exposure component. So actually, I'm sorry, there is an error in the slide. Actually, for Delta, but not for Vega, should have been the above, right? So counterparty credit spread risk, on that we compute Delta, but not Vega, but reference credit spread. Actually, Kirill or Chris, can you just remind me? I think it's for the other one. Let me just table it for a second. Kirill, can you just look up which one you don't have to do the Vega on? I just suddenly not certain. Kirill, if you can look it up and just let me know in the chat, be great, right? But anyway, so there are two credit spread risks here. So for one of them, you don't need to do the Vega. And there is equity and commodities. So essentially, these are the same risk classes as you have. Let me just see here. So somebody is helping me. Okay, so exactly. So yeah, so as I said, the slide is actually not correct. You'd only have Delta but not Vega for counterparty credit spread risk. So I'll correct it before the slides are sent out. And as you see, the risk classes are actually interest rate risk, foreign exchange risk. So these are the same risk classes as for the standardized approach in a trading book, except instead of three credit risk classes differentiated by the type of underlying credit, here we have two risk classes and they're differentiated by the type of what credit is on, your counterparty or everything else. All right, so now let's continue. what are the requirements to regulatory CVA calculation? Regular CVA must be calculated as the expectation of future losses resulting from the default of the counterparty under the assumption that the bank itself is free from the default risk. Okay, so that's a difference from fair value CVA calculation, but it may not be the difference that you think it is, right? So, you read it and then say, okay, so it says that you don't have the DVA, and actually, indeed, there is no capital for DVA. This is not what this provision is about, but let me talk about DVA for the moment. So one thing about CVA is that banks, when they do, P&L calculation, there is a concept of bilateral CVA. So CVA is the expected value of your loss due to counterparty default. DVA is CVA of the other party for you. So that's the loss of your counterparty if you default. The notion of including in your P&L some adjustment to, based on what happens after you default has been, to say the least, highly controversial. And I will, again, so we will run out of time if I even summarize this discussion, let alone go in depth there. But what we need to know here is that there is no DVA here. So if you have in your P&L, allowance for DVA or bilateral CVA, of which DVA is part, whatever, DVA goes up and down, right? So in other words, DVA is something that if your credit quality deteriorates, then your obligations to your counterparties are worth less. So ironically, when your credit spread widens, actually you can book a profit. So that after the financial crisis, when I remember some banks recovered, especially I believe that Citibank was where this adjustment was especially large. So the recovery of banks from the losses due to financial crisis, or the profitability that returned. Well, some of this profitability came, because suddenly credit spread widened, and God forbid, like now we have a profit, right? So that kind of is counterintuitive, but there's no capital for it, so we'll ignore it. And however, what this thing is actually saying a different thing, right? So there is no capital for DVA, it is granted, right? That's not what the provision is about. If you read it carefully, what it's saying is that in fair value methodology, CVA is slightly reduced by the probability that the bank default before the counterparty does. So the formula that we had for the integral that results in CVA, so we had there the survival probability of counterparty. Actually, what we should have put there is also survival probability of us, the bank, because if you have a potential loss on a derivative, and the counterparty defaults before the loss occurs, there is no loss. Well, however, if we default before the loss occurs, also there is no loss. So there should have been two survival probabilities there, counterparties and ours. So what this provision is saying is that don't include the second part. It's a small correction unless your portfolio is very long dated or you're a very risky firm. But nevertheless, it is something to keep in mind. Now, you must use term structure of market implied probability of default estimated from credit spreads observed in the market. So again, so not the number from the rating transition metrics, right? And the difference between them is actually absolutely enormous. So you need to really appreciate this important distinction. There is something that I'm sure everyone here is familiar with, called the market price of risk. So the market price of risk is the price or change in price for riskier investments relative to risk-free or less risky investments, because traders don't like to take risk. So traders on average, market participants on average, are risk averse. And this is why investments which are more risky have lower price. That's the reason long-dated bond yields are higher than short-dated interest rates, is because the longer the maturity of the bond, the more volatile it is, and traders have to be convinced, given the same yield, to take something very volatile, even if on average it pays the same. That's what makes long-dated bonds prices lower and the yields higher. That's also what makes equity grow faster in real world and in risk neutral world and so forth. So the thing is, in credit spread, right, which is something we need to calculate CVA, it has a different market price of risk, is a slightly different manifestation. Because if you're selling protection to someone, if you're entering into a derivative under which you will pay the other party, if someone else defaults. So that's actually very risky, risky derivative for you. If you're selling protection, somebody may default and you may have to pay the entire notional. And because it's so risky, it also attracts very high market price of risk. So the amount of money that you should receive, that traders agree to receive in order for selling protection, right? Because CDS consists of two legs. One is protection leg, where someone who is receiver of this leg receives protection, but otherwise nothing. Receives the insurance payment if the other party defaults, so if the reference name defaults, but otherwise receives nothing. And there's a fee leg, which is the amount of payment for the protection. So the thing is that because traders don't like to sell protection, that's a very risky thing to do. They require a lot of money in the fee leg to be compensated for it, more than the actual historical probability of default. So if you look at the historical default probabilities, which are reported with ratings, and CDS spreads for the same names, you will see that there is probably around a factor of 10 typically difference between credit spreads. When the credit spread essentially is how money you get, so that's your market implied probability of default, right? Not the real one, but market implied, right? What traders assume when pricing CDS in order to enter it, and it has nothing to do, or it doesn't need to be the same as historical. It's just what traders think. And when traders think about it, they think about the risk. So traders price CDS as though the probability of default was 10 times the historical average, typically. Sometimes, 5 times, sometimes 20 times, and so forth, right? So what it means is that if you take historical default probability per year from the rating transition matrix, you will underestimate your CVA by a factor of 10, right? And that's why it's saying that you have to use a market implied probability of default. That creates a huge headache in estimation because it's not available. This market implied probability of default is not available for every name. Must use consensus, expected loss given default, market consensus, right? So that's this ELGD is actually consensus LGD, which is consensus recovery ratio. This is the number next to the CDS spreads on the data vendor terminal. So the thing about it, and I need to accelerate a little bit because we still would like to have time for the Excel examples. So the reason you don't need to estimate it, and actually you don't have to worry. So the previous thing here, which is the market implied probability of default, was a huge headache in terms of how I estimate it. So that thing is actually the opposite. It's not a headache at all. It's just a coding convention. So traders assume certain recovery percentage or loss given default, percentage of money of $1 you get if counterparty defaults, is essentially when they set CDS spread, when they trade, they just have this in mind because it's part of the code. So essentially, it's a coding convention. You don't need to estimate it. You don't need to say, oh, it's not 40%, it's 41.5%, right? It's a coding convention, so you just need to make sure you put the right number in when you put the credit spread in. Must use simulated paths of discounted future exposure. Okay, so that means that you have to use Monte Carlo. Must use risk neutral drift. Historical drift is not allowed, as it shouldn't be for present value of anything, and CVA is present value of a future loss. Must use fat tail model. Well, that's very interesting. So perhaps in the panel we can discuss it. I interpret it as that you have to put in the smile. But reality is that a lot of firms, especially for interest rates, they just use something like Helen White, right? Or they use even perhaps log normal or power law model, but not necessarily with a smile. So, I've seen a lot of simulations of exposure actually are not really using the smile for every risk factor. So it's actually an interesting question how stringently this will be enforced, because there are some markets in which you don't have good data for the smile. So, it's kind of a question mark right now how the supervisors will interpret this requirement. The bank has to have an independent model risk control unit just to make sure that somebody is there to catch errors in CVA model. And no black box models, right? So the risk control unit or any external party has to be able to reproduce the methodology. So what it means is that you cannot just say, well, I have this secret way to simulate future paths, and they show, very losses, if any. So that wouldn't fly, right? So you have to have an open model. You have to disclose exactly how you're doing it. Now, estimation of credit spread is actually, a major headache. And here's why. Like, first of all, well, when it's not a headache is when you trade with a counterparty for which there is liquid CDS. Ideally also denominated in your reporting currency, but because if it's not, that's a little bit of a headache. Well, so if there is CDS on the counterparty, for example, you trade, let's say, with JP Morgan, and lo and behold, here's CDS on JP Morgan right there, and you can trade it, right? Perfect, okay? Now, when there is no when there is no CDS on the counterparty, normally when there are banks, there's usually CDS because a lot of people need it to hedge the CVA for other purposes or hedge something else. Well, when you're trading with the corporates, this is kind of more difficult, right? Because when you're trading with the corporates, then often there is no CDS. Corporates tend to issue bonds, so you can try to get credit spreads from the bond curve. You have to be careful that you can subtract the risk-free rate from the bond yield because you know what it is. But then there is two components remaining, not one, right? So there's credit spread and there's also liquidity spread. Some bonds, they're just not liquid. People don't want to trade them. If you make people buy them, have to basically pay them a little bit extra. So it's hard to separate this liquidity spread from the credit spread, but you can. So that's another way. Now, for liquid counterparties, map to liquid peers. That's the regulation. That's what regulation says. For liquid counterparties, map to liquid peers, taking into account a measure of credit quality, rating, industry, based on rating, such as rating, industry, and region. Okay, so first thing is that, well, I thought no ratings, right? So just before we're saying, hey, you cannot use historical credit spread. So historical credit spread is what you get by looking at the rating transition matrix. So I thought ratings are not allowed, and here we go, right? So there are ratings. Okay, well, the way I interpret this is that you can use rating, industry, and region to map in the liquid counterparty to liquid peers, but then you can use market implied spread of these peers, not the number from the rating transition metrics. There was actually a paper a few years ago, I believe from Nomura, from a quant at Nomura, the name escapes me, unfortunately, and there was some very detailed explanation of how to do that. Okay, so when no credit spread is available for any of the counterparty peers, right? Okay, so far so good, right? So if that's what it means, then we can do it, and actually there are some papers on how to do it. Okay, so then we get to some more shaky ground here, right? So when no credit spread is available for any of the counterparty's peers, funds, project finance, and so forth, you have to use fundamental analysis to proxy the spread. Okay, well, what does proxy mean? Okay, so, well, no, resulting spread cannot be based, the regulation proceeds to say, that resulting spread cannot be based on historical probability of default only. It must relate to credit markets. Okay, well, now it's a real head scratcher here, right? How? So credit markets don't price. We just said that we fall back to this method when credit markets don't price credit risk of the counterparty's peers. Okay, well, so now if they don't, right, so, how do you relate to credit markets? So the only way I can interpret it, and perhaps, again, so one of the panelists, Chris or Jochen or Thomas perhaps can also, clarify this based on their experience or their understanding. So my understanding is that you cannot use historical, and you have to do something like you take the difference between market implied and historical for liquid counterparties, and you have to adjust for historical for this counterparty that you obtain from fundamental analysis. Well, the thing is, how do you adjust? You add or multiply. I mean, the difference between market implied credit spread and historical probability of default per year is not, percent, or it's not tens of percent, right? It's multiple times. It could be up to 10 times, 5 times, and so forth. So it's not going to make much difference if you do the additive adjustment. Maybe you should do multiplicative. So again, so this is something, it's not just a regulation. It's actually, when you're trading CVA, when you're reporting P&L, that's a real challenge to estimate credit spread of these counterparties, and especially when there are no peers, right? So when there's like literally no peer anywhere, you use fundamental analysis, and I think the jury is still out on exactly what's going to be acceptable and what's not, right? So discussion. So we'll perhaps address it in the panel. And finally, you have to estimate. So I'm about to go in the last few slides. So transactions wrong way risk, right? So what is wrong way risk? The regulation says you have to include it. So what is it? Right. Okay. So somebody has a comment. Let me see here. Yeah, exactly right. So I agree with the comment. I think everybody can see my screen. So part of it may be related to wanting risk neutral PDs, where historical one would be physical. That's exactly the point, right? So the historical or physical probabilities of defaults are too low. So you have to use the market. On the other hand, if there is no peers, how do you get there? So this is something I think the panel perhaps could address. But to the best of our understanding of what will happen in the future, in the end, it most likely will be up to supervisor discretion, because in different markets there are different, let's say, numbers of these counterparties for which there is no peer and so forth. And then I think that national discretion will probably be key. All right, so back to wrong way risk. So for transactions with a significant level of dependence between exposure and the counterparty's credit quality, wrong way risk the regulation says that the wrong way risk has to be taken into account. Okay, now, what is it? So wrong way risk is the increase in CVA if the counterparty is more likely to default when the exposure to this counterparty is high. So let's say you have CDS, with one bank. So you have CDS for which counterparty is Bank A, and the reference name is Bank B. So if Bank B defaults, Bank A has to pay you money. Okay, now suppose that financial crisis happened. So in this case, both banks have high credit spread. So Bank Bank B, whose default is protected by Bank A, is now more likely to default. Right? And if given it's more likely to default, the value of CDS increases. But at the same time, the probability that Bank A will default and not pay the CDS also increases. So this is a classical example where, given that there is a component of credit spreads of banks that's driven by the shared factor, health of the financial industry or economy in general. So here, it's not these two things, changes in credit spread of your counterparty and the changes in your exposure or P&L of your trades with the counterparty, they're not independent. If one goes up, the other one is also very likely to go up. So taking this into account can change CVA significantly, and that's what's called wrong way risk. So now it was surprising thing, and Chris, correct me if I'm missing some late clarification here, but at least appears that in a document that despite the high degree of conservatism and various, the regulator is really it's done very good job squashing all of the terms in this quadratic forms that can potentially reduce capital. So every time you see, here's a capital reduction, you then discover that there is some sort of a zero multiplier that emerges and squashes your hope that capital will be reduced. However, right way risk seems to be allowed, right? So in other words, you take into account wrong way risk, you also can take into account right way risk. So if your portfolio is such that when credit spreads widen, you lose money, right? Because remember, CVA is higher when you make money, right, on a trade. So if you lose money on high credit spreads, then in fact there is a right way risk, right? So in other words, in this case, CVA is lower if you take into account the correlation between the probability of counterparty default in your portfolio. So it can go both ways, and in fact, it can not only increase your capital but also decrease it, right? And perhaps this is done because if you didn't do it, then CVA that you report would be out of alignment with what the capital is computed on, and that's not the purpose of this regulation is to protect against the changes in accounting CVA. So I think that certain degree of alignment was required. So perhaps that was the reason why right way risk is also not excluded. And finally, model calibration process for regulatory CVA must be the same as for accounting CVA, except for the margin period of risk. Okay, so my understanding of this carve-out is that accounting bodies have not really been very vocal in requiring sophisticated margin period of risk methods, and I'll talk about what it is in a second. This exception is here basically saying that regulators will be more stringent than accounting bodies. Okay, so now what is it? All right, so collateral agreement helps reduce risk by requiring the counterparties I really should be wrapping up because it's already 10:20, so let me just quickly go through it. So margin period of risk is taken into account that even if you have collateral agreement, which makes counterparty post collateral to you to completely cover any of your possible loss, the counterparty may stop posting collateral before they default, and your loss may change, but collateral wouldn't anymore, and that will result in a loss even if they're supposed to completely cover the loss with collateral. And because of the number of days for sending various legal letters and so forth, it's 9 plus the frequency of remargining, which is normally daily. So it's usually 10 days but it can be in certain cases longer. So that's the margin period of risk. Regulation says you have to take it into account. And finally, hedge eligibility. So again, broader than NBA, but only whole transactions, right? So banks that hedge PV and CVA together against market risk other than for the credit spread of the counterparty will not be able to split the hedges. You have to assign it to one side or the other side, and that's potentially a problem. It's one of the panel questions. Eligible hedges in the SACV, thankfully, include, compared to BVCV, instruments that hedge against the changes in credit spread, but also importantly, instruments that hedge against the changes of other market risk factors, because CVA is as sensitive to other market risk factors as PV that underlies, it is underlying to CVA is. And with that, a few minutes late, but we still have plenty of time for the panel. We have workshop questions, which are on the slide right now. So these are the panelist questions, and we have participant questions, which are more specific methodology questions, and anything else in the panel. So with that, we'll now, Chris, can you put on the screen all of the panelists? And we're going to the panel. So again, everything goes. Please feel free to ask about internal model approach. Feel free to ask about yesterday's session on standardized for a trading book, any of the 4 CVA methods that we covered today, any policy questions, any methodology questions, comments about the weather, everything is welcome. All right, so let's perhaps try to have also more of a, as Thomas suggested yesterday, let's have more of a discussion perhaps instead of just one panelist taking one answer. But for us to do that, we need to also keep the answers very short, because otherwise we run out of time if more than one panelist speaks. So I can see that there are a couple of participant questions which will take priority. Okay, so the first question, what about the distinction between systematic and idiosyncratic wrong way risk? Right, okay, so here's what this question is about. So I can take this one. All right, I go first on this one, and everyone else who would like to comment on a panel, please comment. Also, if a participant would like to comment, please type it in the chat, and we'll see it and ask you to unmute and give you the microphone. So what about distinction between systematic and idiosyncratic wrong risk? So my understanding is that both have to be included. Systematic means that it's wrong way risk with respect to changes that are industry-wide or market-wide. Like, for example, there is a financial crisis, everybody's credit spread goes up. There's a COVID crisis, everybody's credit spread goes up. And idiosyncratic means that it's wrong way risk of the individual name. So, the one example of this idiosyncratic wrong way risk is the example that I covered, where you have 2 banks. You are essentially buying protection from one bank on the other bank. And these banks are in the same city, in the same country. In the financial crisis hits, they may both default. So you lose money. You hope this protection will cover your loss, but the bank that sold you the protection is also defaulting. So that's idiosyncratic. So my understanding is that you need to include both of them. There are various methodologies for doing so, and I haven't seen anything in the regulation that says include one of them and not the other. Anyone else from the panel like to comment? Okay, so any consensus on the modeling of wrong risk? Okay, so yeah, so likewise, also very interesting question. So the regulation says you have to model wrong way risk. It doesn't tell you how. Okay, so there are 2 ways of how to model wrong way risk. So one is that when you build your model for CVA, you have correlations between market risk factors, right? So I'm talking about the model that for the calculation of expected exposure, right? So not the model for credit spread. So the correlation between counterparty credit spread and exposure is subject to wrong way risk. So one way to take it into account is to build a model for the exposure, which has correlations already. You have correlations between, let's say, foreign exchange rates. You have correlation between interest rates. You just add credit spread for your counterparty to this model. You correlate it, or calculate the correlation metrics historically of that credit spread with all of the other market risk factors. And then when you compute this integral, you don't average expected exposure first and then multiply by the survival probability. but you essentially include the survival probability for each individual path, which may be lower or higher depending on the correlation with others. So that's a kind of a classic approach. The problem is that first of all, you have to then do separate simulation for each counterparty, because if you include all of your thousands of counterparties, if you're a large bank, into the simulation, then your correlation matrix becomes too large. In large correlation matrix, it's very difficult to make it positive semi-definite. It tends to blow up. So normally correlation matrix more than 20 or 30 factors is just not going to give you a stable result. Okay, so there is a simpler way. Actually, full disclosure, I published this approach. I like it. I know a lot of banks use it. So it's called exposure sampling. Essentially, what you do is that you take historical correlation between your PV with the counterparty and the credit spread of the counterparty. So you first use expected. You first calculate expected exposure the usual way, and then essentially you do a very simple bivariate normal process in which you have Pearson correlation, Gaussian correlation, based on historical correlation of the counterparty's credit spread and PV with that counterparty. And if in the past credit spread widening was associated with higher PV, then you have wrong way risk. If it was in the past associated with lower PV, you have right way risk. And actually, probably in a month or two, you'll see a paper in Risk that we're currently writing on how this approach worked during the COVID crisis. So I like this method. It sidesteps this whole issue of whole challenge of having to deal with very large correlation metrics or having to repeat the simulation for each counterparty separately. And I believe it's a workable approach. But the regulation doesn't tell you how. It just has to. It just says that you have to take into account. Any other participant questions, please put them in the chat. So far, because there are none, so let's go to the first panel question, which is more a policy question. So what's the expected impact of FRTB on CVA trading for financial institutions? If you're a participant from a bank, perhaps you can comment about your institution. If you're a regulator or industry expert, this question about generally the institutions that you've seen. So I'll turn it over to the panel. So Jochen or Thomas, would like to comment? Okay, so let me start, and then if anyone would like to comment from the audience, certainly, please, you're welcome. Please put it in the chat. So I think that one thing that early on was the concern is that there was no centralized management of CVA. So back when the initial regulation was published, there was this requirement that there is a CVA desk, which at the time the banks were just setting up the CVA desks. And it seems that this may be onerous. Essentially, you're trading CVA at the normal trading desk level, and then all of a sudden you have to have the CVA desk. So I think right now, just given that if you trade FX, you trade interest rates and so forth, many of these asset classes that you trade are with the same counterparty. And in order to compute CVA with the counterparty, you have to take all of the trades with that counterparty or within the netting set and model them together, hash together. So CVA function. It may be CVA desk, it may have different, but essentially a centralized CVA function within the bank is kind of right now is not controversial or seen as a requirement that results from the regulation. Everybody I think understands that this is anyway the right thing to do. So that impact is it happened and it probably would have happened without the regulation. But I think that one thing that definitely I've seen and I've heard a lot of concern about is the lack of recognition for partial hedges. And what it means is the following, is that in the regulation here, there are a couple of places where you can create kind of synthetic splits. Like if, for example, there's one place in the regulation where it says you can create a synthetic netting set if some of the trades are on the basic and some of the standardized, you can create a synthetic netting set where in reality there is one common netting set for both types of transactions. But there is no synthetic hedges here. Because what happens is that if we see in this example, if you have very high CVA, essentially it eats up your PV, right? So if counterparty owes you money in the future, but you know that they're about to default, then your PV, your CVA-free PV with them is exactly the negative of CVA. In other words, once you take into account CVA, your PV becomes zero because let's say that for sure that you default tomorrow, they're supposed to pay you money 10 years from now. So whatever PV of that payment is, CVA is exactly minus that. So then total is 0, right? So the thing is, normally it's not as extreme, but if you have a risky counterparty, let's say counterparty that became distressed since you made the trade, and this trade is a very long dated trade, CVA can actually be a significant fraction of your PV with that counterparty. It could be 5%, 10%, 20%. So actually, when you're hedging market risk exposure, banks very often have to hedge at the same time, or it's optimal from the desk risk perspective to hedge both PV and both CVA and CVA at the same time. Okay, so now the thing is, when you have multiple trading desks and a single CVA desk, that creates also a bit of a challenge where the banks, so the trading desk will be hedging potentially their own PV, and then CVA desk, which has a central CVA responsibility for CVA, would be doing perhaps a separate hedge, which is costly in terms of transaction costs, or maybe even the opposite hedge, which is even more costly for the sum. But if you have, let's say, a counterparty that deals with one trading desk, and there is no issue of setting. Let's say there is a counterparty, let's say that you only trade interest rates with, but nothing else, right? Or perhaps a corporate, right? A corporate that only did one type of trade with one trading desk. So the desk would actually, from the point of view of transaction costs and point of view generally of simplifying the management of your hedges, it would make sense to have a single hedge for PV inclusive of CVA. So for the basically PV, CVA adjusted PV. But in a regulation, you have to put it onto one bucket or the other. So I think that there is a potential impact here that unless this rule is clarified in a way that that makes it permitted, that some hedges that were hedges for the PV and CVA together will have to become separate hedges, because otherwise you would not be able to get capital benefit from these hedges under the regulation as written right now. So that's one change, I believe, that can occur. And also, of course, the other thing is, as always, you have a new capital requirement, so potentially it can suppress certain kinds of trading. And with CVA, I think CVA is something that you don't just unlike with the trading book where something is very capital intensive. Well, you just don't trade that. So CVA, you cannot just not trade CVA. It's there. So it may impact CVA capital charge if it's high on a particular type of instrument. For example, it's going to be particularly high on things like CDS, right? So basically, if you trade CDS, you have a very high counterparty credit risk there, but also high CVA risk. So it may change your trading in general, not just CVA trading, just by making certain trades a lot more capital intensive than they were previously. Right, so that's my take on it. Anybody from the audience would like to comment? Okay, so there's a comment from Shengjiao Zhu. So I'll read out the comment. At least for EU banks, market risk hedge of CVA trading get fair capital treatment after FRTB. In current regulations, these positions have to be included in the market risk capital. Yeah, so I think the comment is right. So if you would you like to unmute and comment? Just make sure that instead of me interpreting your statement, can you clarify? Are you talking about potentially these hedges being back on the market risk and basically becoming circular? Is that the comment? Perhaps if you can unmute. Yeah. Go ahead.
Can you hear me?
Yes.
Yes, so the comments is about because currently in the regulation say that if you put interest rate hedge and FX hedge of CVA, and that hedge position has to be included in the market risk capital, but the underlying exposure are not allowed to be, or for most bank, the underlying exposure was not being captured in the market risk capital right now. So then you get a directional position in your market risk book, or in your market risk model. So then you get an unfair, so somehow get an unfair treatment on the capital side in the current regulation. And of course, that issue will be solved after FRTB when we have this for this formula which capture all asset classes. And I think that's also a few risk article was published during the summer this year to discuss about this.
Yeah. Right. Okay. So thank you for making the comment. Right. Exactly. Yeah. So essentially, there is a mismatch here where you have to do something for CVA, and essentially whatever you're doing to help with it. So that's one of the examples of disconnect between desk risk, where you have to hedge your CVA in order to avoid P&L volatility, and the capital misalignment with the avoidance, with the hedges that avoid P&L volatility, we have to pay capital on something that essentially reduces your risk. Yeah, and it's good that with the introduction of FRTB, which unfortunately may not happen for a couple of years now, this will go away, but it doesn't. It does present a problem right now. Anyone else would like to comment?
And maybe to add on that, and I think that is also, it was a very important point, because it was basically disincentivizing desired behavior of market participants, and it sometimes when you were looking at the overall risk capital of a bank, of the market risk capital, you could actually find that 20 to 30% could go into these CVA hedges, which were not adding risk, but actually supposed to remove it. And the other aspect, which you have already mentioned technically, but which I would like to point out, is that there was a discussion in the beginning of the FRTB consultations, right, about whether to use historic or the P or the Q measure, and the fact that we went to implied data basically means that we are much closer to the reality of the banks, where actually these risks are hedged and have to be hedgeable. And I think that was definitely a move of the regulator in a very good direction.
Thank you. Anybody else would like to comment on this first question? All right, so let's move to the second one. So will FRTB change how you book and hedge CVA? So that's related to the first question, is different. And if yes, how? Right. So I think that one of the potential changes is what I just mentioned about having to do separate hedges when you hedge multiple things together, multiple types of CVA, multiple types of XVA, and PV and XVA together. So one thing here is that other than for the benefit in certain situations, especially when it's all concentrated on one desk, of hedging CVA and PV together, there's also benefit in hedging XVA together. So the banks, other than CVA, often include in their P&L other types of XVA. Now, there is a debate in the industry of what, which types of XVA are actually appropriate for inclusion in P&L, and that's a topic for an entire separate panel. It's probably 2 hours wouldn't be enough for this discussion, but we're not here to discuss whether it's appropriate. We wanted to acknowledge, what we're essentially acknowledging that is happening, and the desk may manage not just CVA but also other types of XVA. And DVA, basically various capital adjustments, funding. Basically, there's funding value adjustment. There's collateral value adjustment. So basically, funding value adjustment is somewhat controversial, and there's probably 100 papers on it, of which in risk I think there are 2 in a recent year, and the pace doesn't subside. Where there is a whole zoo of XVAs which have all of very fine offsets, and they take into account various corrections, basically of the risk transfer or value transfer between shareholders, bondholders, for each counterparty and so forth. But under some of these treatments, it is appropriate to include funding value adjustment into your XVA, and the funding value adjustment is based on the spread between what you're funding and the risk-free rate or rate and collateral. Then there is a call VA, which has to do with the rate paid on collateral being different from the risk-free rate. Then there are various capital value adjustments, which is essentially present value of the extra expense of capital that you have to allocate. So I think that one way to see this question is that we have XVAs that the CVA desk is often the XVA desk, and it deals with value adjustments other than credit value adjustment. and they're hedging them all holistically together. And the question is whether with FRTB you have to change the way you do that. You have to change hedge CVA separately. Otherwise, again, so you may have this treatment of hedges that cannot be split, cost extra capital. So, any comments on that? Anybody would like to comment on whether this particular aspect is a problem from your point of view, or anything else that in FRTB that will make you change how you book and hedge CVA?
Well, I think let's put it this way: you have to very carefully look at your booking model. The regulation is basically a decade behind the industry in looking at this. CVA was basically gaining general acceptance when FRTB was begun, and it's now in the capital regulation. The other VAs might come in the future, but until then, we might very well have a situation like we had for CVA and have for CVA now, that the capital treatment isn't entirely consistent with the PV, right?
But can you elaborate? You said decade behind the booking model. Can you elaborate specific, like a couple of examples?
It's a question of how you book. What you said, how you book your hedges. To actually, I'm not even sure your regulator will allow you to exclude hedges that are for FVA from either the CVA or market risk capital. You probably have to allocate these positions to one or the other, and it will presumably get some capital charge that is again going to increase. Capital for risk that you're actually hedging, but until FVA or the other adjustments get recognized on the capital, there's going to be a discrepancy, right?
Right. Yeah. Exactly. So in other words, so I agree completely. If you look at the conferences and papers, there's really the whole zoo of various value adjustments, and literally quants run out of abbreviations for them, and they already exhausted all of the 3-letter abbreviations and now go to 4 and 5 letters. Here we just talk about CVA, whereas it's really part of a family. And I think it's a very real problem where the regulation, for reasons certainly completely valid, has to go slowly. Comments have to be gathered. It has to be implemented in multiple countries. So the industry moves forward very fast, and that creates a misalignment, temporary misalignment, which is what the previous comment was about. Basically, that FRTB will fix some of the problems currently that are caused by the current regulation, but when it comes into effect, there will be other problems that are just resulting, as you said, from the industry moving faster than the pace of regulation. And the pace of regulation, there is a limit how fast you can go, just because you have to gather a consensus in order to move forward. All right, so a couple more questions from the audience. Will RFR linked instruments be accepted as hedges if the portfolio contains mostly legacy LIBOR product? I think, Chris, can you comment, or can someone from the panel comment? I think I know the answer, but I'm not 100% sure. Anyone else? Anybody from the panel is comfortable answering this?
I mean, I need to look into it a little bit, but I'd also appreciate if the person who asked the question gave a little bit more background on exactly why you think that would cause a large issue.
In other words, what makes them special that you think that exactly? What makes them special that you believe that they may not be accepted? Because generally, if you're talking about standardized, where hedges other than credit than CDS are accepted, normally I see no reason why they wouldn't be. But perhaps we are not understanding the question. Can you unmute and comment, perhaps? Chris, is the participant able to unmute? Okay, so if you're able to comment, please comment. But otherwise, yeah. So my understanding is that there is no restriction on what is accepted as a hedge and standardized. Essentially, whatever you say is a hedge is a hedge. You just assign it to the category. So I don't believe there is an issue here. Especially, really, this regulation doesn't deal. There's nothing in the MAR50 document that deals specifically with the labor transition. So I don't believe will be any special treatment of these instruments. At least that's my understanding. All right. So next question, and that's from Jochen. I'm not too sure. So the comment is, I'm not too sure that FRTB SA solves the problem of exposure hedge capital. Our estimate is that unless capital is hedged closely, basic CVA may produce less capital than SA. In hedging, capital produces worse XVA hedges in P&L, since P&L hedges include hedges of, for example, DVA. Right. Okay. So that's actually a very interesting comment. So so I think that. Or at least, my understanding, and again, perhaps Chris can comment on it further, is that the intention was to make BA sufficiently conservative such that standardized is a better method, as generally, the regulators tend to favor more risk-sensitive methods. So, Chris, are you able to comment, like, have you seen, and again, I'm not sure how much you can say, given that's a public forum, and again, so I wanted to also emphasize that, as I said in the beginning, all of the opinions are the opinions of the participants personally, and are not necessarily the opinions of the employers. And with this being said, is it a typical problem? Do a lot of banks see that? Perhaps, Chris, you can comment, or other participants can comment. How many banks expect that basic would actually be more beneficial and would have no incentive to go to standardized?
Broadly speaking, my understanding is that basic CVA has been more conservative than SA CVA. But with that said, Jochen, if you'd like to send me an email, I can put my email in the general area with some more details. I'd certainly be curious to see why it is that you're saying basic CVA is going to be less conservative.
If you'd like to unmute and comment, I believe it, the way I understand it, it has to do with exactly this issue that it's a regulation about CVA, whereas the bank hedges are the XVA. So perhaps it's just because of these other XVA hedges for other XVAs, like DVA. That's my understanding of the question. But Jochen, if you can unmute, if you're able to unmute and comment.
Yes, can you hear me?
Yes.
Can you hear me? Okay. Yes. Yeah, exactly. So we just made some basic numbers, but indeed we did obtain lower numbers for basic CVA than standardized CVA in our calculations, basically due to this effect, because for example, DVA is a natural credit hedge to CVA. So on the counterparty credit risk side, you typically don't hedge your entire credit risk exposure. But though that offsetting is not allowed in these formulas, and the standardized approach works very well if you have a very good hedged capital exposure. But since your CVA in accounting includes other components, we don't really see the full effect of the standardized approach working well. I mean, it could be the early days, and we haven't learned to optimize the capital formula yet, but at least a naive approach provides slightly less capital for the basic approach.
Okay, thank you. Yeah, okay. Thank you very much for sharing this. So clearly it kind of goes back to the main problem with basically as we've already understood, there are multiple ways in which the industry moved ahead of the regulation, and if this continues, then there will be probably always some degree of misalignment between the way that people book P&L and what the regulation covers. And in this particular case, it's interesting that it even made basic, which is very conservative, more favorable than standardized, just because standardized was not able to recognize, etc. So that's very interesting. Anyone else would like to comment on that, or
one thing,
anybody else has similar experience?
Yeah, one thing. My understanding is that the Basel Committee is firmly of the opinion that DVA should not be. You shouldn't recognize benefits from your own credit losses credit quality deteriorating. So I think they explicitly included or take the view that DVA should not be in P&L and hence you should not be able to get capital relief from it. Of course, you can argue endlessly about this. Personally, I tend to agree that you probably can't hedge DVAs. You shouldn't be recognizing it, but it's a debate you can probably do endlessly. But it's clearly the regulation clearly intends you not to be able to include your DVA in your P&L, and hence if you do and you hedge it, then you're going to incur capital charges. Now, I do know that with some accounting regimes that doesn't sit very well, because the accountants have a different opinion in in certain countries, in certain jurisdictions. So there's going to be a problem, but I think that's going to be sorted out more easily by discussions with the accountants than with the regulators, because the time frame is a lot shorter.
Right. Okay. Okay. Thank you for this comment. All right. So let me just because we're getting pretty close to the end of the session. So let me, as the next question, I would like to answer the question yesterday about these examples. So we will make available for download along with a slide these examples. So I just want to show how it works. So each example, and I'm looking right now at the. I hope you can see my screen. Can everybody see the screen? The Excel on the screen? Yeah, okay. Right, so I don't want to take a lot of time, but again, key thing there is that please don't use it for anything other than learning purposes, because it's a simplified example, but it's essentially it's a spreadsheet in which there are multiple, really tens of tabs here, and there are hyperlinks. So this is the total capital requirement calculated here on this first sheet. Right, so that's the amount, and then you go next, and it basically moves you from a set of tabs in which there's a formula, and there is an example of how to use the formula. So if you're like me, where you're a little intimidated by all of this notation, which is sometimes different from one page in the document to the next, then I found this example very helpful, which Kirill Lashevsky, who is my colleague and here on Zoom with us, has prepared. So I found it very helpful in understanding how the calculation works end to end, and we'll make it available. So I just wanted to show it very briefly. Okay, right. So so with that, let me go back to the slides and with questions. And so the next. Let me perhaps go to the participant questions. So we only have time perhaps for 1 or 2 questions. So one thing is, it's kind of 2 participant questions are both about the lack of alignment between MAR50 and the MAR21, 22, 23 documents, or rather MAR21. Because MAR50 in particular has an FAQ, so it's not in a document, but it's an FAQ that allows calculation methods for sensitivities other than one-sided shift by 1% or 1 basis point. Right, so there was, in fact, I remember, this was by debate, a joint algorithmic differentiation, which was introduced. And so there was a lot of discussion, a lot of people submitted FAQs that essentially, can we use anything other than this one-sided shift to compute sensitivities, because it's computationally effective to do so, and there's a major computational burden in computing the sensitivities. So for CVA, it was clarified that you can. Right, but not for, at least to my knowledge, not for the market risk. And I think the general assumption is it's safe to use this method. You don't have to use specifically one-sided shift by a fixed amount, but it'd be nice to confirm that. And conversely, which is slightly different type of question, right? So now MAR21 allows base currency to be different from the reporting currency, and it would be logical if MAR50 also allowed that, but it doesn't. So I think that there are different ways that this goes absent further clarification. I think in the first one, I would say I would probably feel safe using this methods, meaning a joint differentiation or just analytical formula for sensitivities, even if there is no FAQ. But I believe the banks are not allowed to change base currency to make base currency different from the reporting currency unless expressly permitted in the document, and MAR21 or standardized for trading book permits us, while MAR50 CVA regulation doesn't. So anyone can comment. What's your understanding of one is permitted, the other one isn't, or it's just it's a matter of time, and eventually there will be an FAQ that permits that aligns them.
Actually, I think it's been pretty clear all along that you are allowed to use calculations essentially equivalent. I can't remember, but there are footnotes somewhere in FRTB. They've moved with the new version, so I can't remember exactly where it is, but it does allow you to use whatever your trading system outputs explicitly. And the logic was always that because you have the curvature charge, that if there are small differences to second order effects, they would be captured by the curvature charge. So yes, I would say that there shouldn't be a problem. Of course, if it has to be scaled so that it's essentially equivalent to.
Right. Okay. Okay, and what about the second one?
Well,
That's different, right? Yeah.
Yeah, I think it's frankly, I have to sit down and go through it carefully, but as far as I can see, it wouldn't give you anything because there's no curvature charge in MAR50 on the CVA, right? For the purely linear charges, whether you have a base currency different doesn't change anything.
I believe it does because there are still some nonlinear effects there. So I believe that even in the absence of a curvature charge, essentially the way that these correlations work. So a couple of ways that it can be different. First of all, I believe again, so but that has to be confirmed. That I believe that even if it was completely linear, there will still be an effect. But one thing that can happen is that your base currency may be in one of the specified currencies that have lower risk weights, and your reporting currency may not be. So what happens is that by going from an emerging market currency to base currency that's $1, then you're taking advantage of this lower risk weights for the specified currencies. And then you're essentially just converting it back to your domestic currency, and here you go, right? So you have a lower risk weight. So I think that definitely is something that's going to affect it. But I believe that even for linear instruments, you still will get some effect, even just because of how these correlations work. If you have currencies that are other than either of these currencies in your portfolio, because there will be different interplay between correlations. Yeah, so my understanding is that we need to wrap up, but because it has been 2 hours. But yeah, so Jochen, my understanding is exactly the same. So I haven't actually seen, perhaps if you can send me after the, if it indeed exists, if you can send me after the workshop, I can put it in the slides. But I believe that this FAQ that we can use analytical for sensitivities is only for CVA, but not for the standardized for the trading book. But perhaps because you're right, I mean, it was completely clear that the way convexity works, it should be the linear sensitivity. So perhaps it's not there because it's clear. But on the second one, it's the opposite. So I believe that the consensus is that unless the regulation specifically allows to change base currency to be different from the reporting currency, you cannot do it, right? Because that's not just the sensitivity of 1 basis point versus the analytical delta, right? That's a major thing, right? And it's allowed in MAR21, but not MAR50. And clearly, it would be more consistent to rely on both. And I think it creates actually a very practical issue where there are markets in which there is no CDS, expressed, there is no CDS denominated in domestic currency. Foreign exchange is relative to the dollar. So there are a lot of markets in which actually would be highly beneficial and solve a lot of data headaches to use the different currencies. And that's why it was permitted for MAR21. And if it was permitted eventually for MAR50 through a future FAQ, I think it would certainly, bankers in countries other than dollar or euro would certainly appreciate it. All right, so with that, we need to wrap. Thank you, everyone. Thank everyone for joining us today. The participants and the panelists. So I believe that it was. I hope it was useful. It certainly was very useful for me. I hope it was very useful for everybody who dialed in.